Hello, welcome back. Hope you're having an awesome day. Today we're going to be taking a look at Tesla. It's been a while since I last took a look at the company, and it's had its next split, which was a 3-to-1 split, and we're going to be talking a little bit about it. Now, if you are new here, remember to leave a like and subscribe. That helps a ton, and thank you for being around. Let's take a look at what is Tesla doing and whether it's a nice buy right now. Now, if you take a look at our splits history module here, you will see that Tesla has already split the stock 2 times. The first one was a 5-to-1 split, the second one was a 3-to-1 split. Of course, all our metrics here in the tool are adjusted, and you can kind of see that currently the stock is sitting at $276. If you take a look at the 5-year chart, you will see a little bit of a decline, along with the overall market, which has been going down. Still 33% sounds like a breeze compared to some other companies that have gone down quite a lot, much more than this one. Now, after it has fallen down quite some, and it's generally speaking, since the company keeps doing well, its valuation has dropped a little bit in terms of how expensive it was. Now, we will examine in this video what kind of price it makes sense to pay and how Tesla is doing financially, and whether it's a potentially interesting opportunity to potentially think about adding some Tesla here in a portfolio, or is it still too expensive to actually consider. So let's take a look at it. Now, the P ratio of the company is sitting at 100, pretty much 101, like going up and down a little bit. But remember, it used to be much higher, so it kind of keeps going downwards. Still expensive though, and the price to free cash flow still also very expensive at 250. Now, the outstanding shares, the company has been taking advantage of this kind of an increase in the share price, the stock price, and they have been printing shares throughout the stock price increase. And they haven't stopped, they are still printing, pretty much indicating to the overall crowd that they still think that the stock price is relatively expensive or very expensive. And so this is why they keep basically selling stock. And of course, Tesla is also a very cash intensive business here, and so they do need tons of cash, and the easiest way to get cash and spend less about for it is actually getting it from investors. So basically selling shares in the open market, and this is what they have been doing, pretty much diluting investors 25% over here, and they don't seem to be stopping is the bad thing pretty much. Now, in terms of free cash flow and total liabilities, it seems like it would take about 9 years of last year's free cash flow for Tesla to pay back all their total liabilities here. So we will examine this in a little bit more detail because it also may be a fluke. We'll see about that. But in terms of growth here, the company has been growing tremendously nice, and you will see it in pretty much in every metric here. It keeps going upwards, and it keeps increasing everything in terms of its top and bottom lines, which is great to see. And as an investor, that is definitely what you want to be seeing, but you kind of want to be buying it at a cheap price as well. So it's a combination of 2 things. It's not just the company doing great, it's also you, the investor, getting the company for a cheap price. Otherwise, you can still be making a bad investment. And in terms of the data the company has, it doesn't look like it's a lot compared to its equity, but remember, they have been increasing their equity by issuing shares. So, the more shares you issue, the more money you make out of these shares, so the more you increase your cash reserves. Okay, so what's next about the company? So the margins that they are making have also been increasing, and that's great to see, especially for a car company. These kind of margins are actually pretty nice, and I hope they can keep at least keep them at the same level or increase them. At some point, I think some quarters were near 18% as well. So this is nice to see, because typically car companies are trading at lower margins, are actually making less net income compared to the revenue that they generate. So this is very nice to see for the company. Now, in terms of the income statement, what is going on here? A story of growth, of course, a company that has been growing its revenue tremendously. And in terms of the net income, it has been also making some positive steps here. Now, it used to be negative for a while, but it keeps increasing, and people seem to be liking Teslas, of course. So the company seems to be pretty much going towards profitability, better and better profitability through the years here. So this is nice to see. They keep doing better and better in terms of what they are doing. Now, the big problem with this company is not their operations, is the fact that people have loved the stock so much and they have been piling in on the stock so much that they have increased the price to a massive level. And this is the big problem with Tesla. It's not the company by itself. I would love to own Tesla, but the price may be a little bit expensive right now. And if it goes down lower, then we may talk about it. So it may still be there. I mean, we will examine it later, but so far it does look like it's still expensive. We will see with our stock evaluation tool as well, which will give us a better picture. Now, if you take a look at the total equity of the company from 5 billion to 31 billion. Now, again, they have been increasing the total equity because of additional paid-in capital. And additional paid-in capital is basically what the company is generating by issuing shares. And of course, you can see here that a lot of their income, a lot of their total equity, I should say, comes from the additional paid-in capital that they generated through selling stock. Of course, at these prices that the stock had, remember it was $1,000 before the split, the company's stock price is was actually very elevated, and so they could make a ton of money. And why not? If I were the board of Tesla, I could do the same thing pretty much. In terms of the net income, pretty much you'll see here a picture of the net income going up and up and up and up, and the operating cash flow 11.5 billion after the adjustments here for the stock-based compensation and depreciation amortization. This is still, or at least I think was, a Bay Area company. I think they moved recently, but that means that they pay a lot with stock. And this could mean two things. Actually, the fact that you would be getting a lot of adjustments here in terms of the operating cash flow that is going to be added back, and also that they could be issuing a ton of shares to actually cover this stock-based compensation. So you kind of have to be a little bit careful about these kinds of companies a little bit. So in terms of the company's financing here, you will see that they pay back some debt. They still get debt and pay back, but overall they're actually a net buyer of their loans pretty much. So they're getting their debt settled, I should say. And in terms of the investing activities over here, you will see that they're mostly investing in capital expenditures, which obviously makes a ton of sense for a company like Tesla. And after the adjustments, after the extraction of the capital expenditure from operating cash flow, we get to the free cash flow, which is sitting at 3.4 billion for the last year pretty much, and keeps increasing. And this is looking like a nice picture. But what about our stock evaluation tool? What does it tell us in terms of the price of the stock? Is it a buy where it is right now? Now, of course, the company's revenue growth has been tremendous. The company has been growing their revenue at a fantastic pace, but this is not going to continue forever. Of course, the company cannot be growing their revenue at like 70%, 20%, actually 20 is possible, like 50%, 60%. That's a lot. This can't and won't be happening every year. Of course, it will slow down, no doubt about it. So we will go a little bit more conservative, but still keep accounting on the fact that the company will be growing at pretty nice numbers here. So I'm going to use 10, 15, and 20, which I think make a ton of sense here for Tesla, and I think that they are potentially easily achievable. Now remember that we are having a little bit of a downturn, so at this kind of an environment, we could be doing some years, like maybe a couple of years, where the company's revenue growth could be less. They could be 5%, 8%, who knows. But then coming out of this one, you may also get elevated revenue growth, which kind of compensates for the previous years. So we're going to go 10, 15, and 20, and you can actually make your own assumptions by becoming a patron and gain access to this tool, which you can find links for in the description below this video if you're interested. But of course, yeah, when you gain access to this tool, you can try all sorts of projections on your own. In terms of net income margins here, remember the company has been making it better and better. So last year was 10, now it's currently more close to 14. So we're going to go somewhere in between. Let's go 8, 10, and 13 here. So this is again a little bit conservative because the company has been doing better than this lately. So I could see a case of maybe 10, 12, and 14 even. But I'm just going to go a little bit more conservative on this one. In terms of the free cash flow margins, again, a little bit all over the place, which would make a ton of sense for a company that is growing that much, of course. But I will go with something that is relatively normal, 80, 90, and 100. And the annual return of 13%, what I typically want to be making out of my stocks. Hit calculate, and what are we getting here? You will see that we are very far is the problem. Again, what I talked about earlier, great company, they are doing well, they're increasing their margins, but they are still very expensive. And so, this doesn't make a ton of sense for a buy over here. Again, not because of the business, but because of how expensive the stock is. So I do like the Tesla business. I like Teslas a lot myself. I could consider buying one at some point as well. But in terms of the actual stock, I think I'll have to wait it out. It's just not the proper time for me to be entering this one right now. So I'm gonna be on the sidelines and wait. Just wait. Maybe it will just get a little bit of a crash at some point. Who knows? We'll see. But thank you for watching. Again, if you're new around here, remember to subscribe and also leave a like if you enjoyed this video. And in the meantime, take a look at this one that I made earlier about Snapchat. And I'll see you in the next video as well. Bye bye.